Good morning and welcome to everyone who's joined us for our socially distanced webinar. My name is Sandile Malinga and I'm excited to be the host of this hopefully thought-provoking, interesting, and we hope certainly insightful panel discussion conversation. I'm joined by my two colleagues, David Nee and Marc Beckenstrater, who are infinitely more qualified than I am. So I'm very happy to be the one posing the questions this time around. A little bit of housekeeping. We've got live Q&A, so please do continue to ask us questions. If there's some questions you weren't able to pose or didn't come to you when you were registering, please do continue asking us questions throughout the webinar. At the end, we will conduct a live Q&A where you can also still continue to ask us questions. And yeah, a reminder, CPD points are available for this webinar. Okay, to kick off, let's not waste any time. South Africa has really faced quite an interesting and quite a difficult last 5 years, certainly from a political perspective, but most pertinently for us from a returns perspective. Equities, for example, have only delivered 4.75% per annum over the last 5 years, which is significantly lower than what we would expect. Listed property, for example, has delivered minus 13% per annum over the last 5 years. So the two asset classes where you expect most of your returns to come from have actually been the lowest returning ones. So it's quite understandable the level of despondency and disappointment that we all have as investors with the current recent experience of returns. So perhaps to kick off, David and Marc, we could start here and whether you can share some thoughts about why you think the last 5 years have been as disappointing as they have, and lots of questions that we get asked by our investors are actually, why should the next 5 years be any different? David, you want to kick off?
Sure. I mean, perhaps from a South African perspective, and then Marc can come in and provide some more global colour. Yeah, Sandile, as you've highlighted, very disappointing 5-year period. Clearly, this 5-year period we've just had followed on from 5 years of plenty. Between 2009 and the end of 2013, the equity market tripled. So there were some very compelling returns that preceded. So some of it is the natural kind of ebb and flow, but we're familiar with a number of other factors that have compounded, I think, the weakness that we've seen in risk assets. So poor economic growth, political concerns in South Africa, and clearly as well more recently concerns about the fiscal sustainability and what that might mean for South African growth, how increased government borrowing is crowding out private sector investment and limiting the ability of the economy to recover, the lack of supply side reform. So there are all of these kind of impediments that have weighed on South African assets. I think the challenge is always to think about when is the right time to buy against that backdrop, and I think we'll be coming to some of those questions a little bit later on. Yeah. I do think that we can point to a number of things which are shifting in terms of the outlook. So we are starting to see some reform coming through, for instance, on power generation. We've seen 11, 12 gigawatts of potential new IPPs coming online, the independent power producers, over the next kind of 2 to 5 years. We've seen the National Prosecuting Authority starting to actually tackle corruption in a more, I think, a more material way. Because that, I think that was a disappointment to both local and international investors. And we've also obviously seen the Reserve Bank, react to the economic slowdown with some very material interest rate cuts, and all of that obviously is against a backdrop of inflation expectations coming down. So we are kind of well anchored from an inflation perspective, which I think is a difference to a lot of other emerging markets where there are similar concerns where perhaps the Reserve Bank is perhaps doesn't have the credibility that the SARB has. So yeah, I mean, I think let's wait some further questions to get into some of the questions about valuations and catalysts and things like that. But you know, I mean, we do need growth to start to turn. You know, it's been the last 5 years have seen ever weakening rates of growth. So yeah, we can touch on why we might be kind of more optimistic about that. But maybe Marc can provide some global thoughts as well.
Marc, some thoughts on the global front?
I'll just I'll just jump in here. So the reality is that at the big index levels overseas, you've done very well over the last 5 years. If you've owned global bonds, say the Barclays Global Ag, or you've owned the MSCI All Country World Index, you've done very, very well. So being exposed to assets other than cash in a global environment, you can't complain about the returns. Your forward-looking returns are a more challenging prospect. The S&P has carried at the equity level. The S&P has carried a lot of that return burden. So it has outperformed the MSCI X, the US. The S&P has been the stellar outperformer. And that's, we've got a couple of slides here, but it's worth just, focusing on that slide one, which is the S&P 500 versus like emerging markets and the MSCI X, the US. The difference in the returns, which have been okay for those assets, has been about the earnings delivery. So 5 years ago, you would have, if you were using valuation as your guideline, you would have bought more of the MSCI X, the US, you would have bought more of the emerging markets, and you would have underperformed the S&P, despite starting with a lower PE there or a higher earnings yield. So your prospective return would have looked better. Didn't turn out to be true because the earnings delivery of the S&P was superior to emerging markets and to the World X, the US. Unfortunately, you couldn't have known that at the time. I mean, we definitely didn't. Anybody who did is probably, anybody who says they did today is probably suffering from hindsight bias because the valuation didn't really do that. We did have a slide on slide 6 and 7, which just breaks down what we call the earnings bridge, and it breaks down those earnings numbers and shows you that most of the disappointment in the rest of the world versus the S&P came from the sector composition. So the S&P won because the big sectors in the S&P are information technology mostly, and then some of the communication services numbers and financials in the US actually grew substantially from 2007 through to 2019. So this has been going on for a very long time. So that outperformance relative to emerging markets and the MSCI X, the US, where unfortunately the financials in those markets, the energy stocks, so you think about the big oil stocks and what's happened to oil, and material stocks have significantly underperformed in terms of earnings. So that's the broad brushstroke. I'd make one last comment in terms of, all assets have done badly in South Africa. Sandile and I did look at this during the week, but the South African All Bond Index has actually virtually matched the US 10-year bond for returns in rands or in dollars over the last, so both of them in dollars or both of them in rands over the last 5 years.
Yeah, it's actually done a little bit better in rands, Marc. So it's.
So that is an astounding result, which talks to. I think David will talk a bit more to this later, but talks to the power of starting valuations as you allow your time horizons to extend.
I mean that's actually a very good point, and perhaps gets us quite nicely onto my sort of follow-up question, which has to do with returns, but also I think flows. As we've seen, the sort of ASISA flows that we've seen are quite interesting, especially when you contrast those with the returns that have been enjoyed. So, flows out of balance funds have been quite negative and have literally been on a decreasing trend for the last 5 years, Whereas, when you look at where the money has gone, it's actually gone into cash and multi-asset income. So, that's what investors have been doing with their money. Any thoughts on that? Are you guys doing the same in the portfolios?
Look, I mean, our investment approach doesn't tend to, seek to risk mitigate over short periods of time. So, we are aiming to deliver superior medium term returns on a risk-conscious basis to our clients. And what that has meant over the 25 years or so that Prudential's been in South Africa, and obviously much longer globally, is that when assets become cheap, then we aim to go kind of overweight those cheap assets. Marc touched on the issue of starting valuation. I mean, that's an interesting one with regard to the question we were just talking about. What happened over the last 5 years? Because 5 years ago, actually South African equities were priced a little bit cheap, even to their kind of long-term history, and South African bonds were distinctly cheap. That was kind of just in the kind of run-up to kind of Nenegate. And they're already elevated, those bond yields, and obviously became more so after Nenegate. So it wasn't that those assets were expensive. But in the case of bonds, they have become modestly cheaper in aggregate than they were then, but not dramatically so, which is why the returns, as you were highlighting, Sandile, have been reasonably decent from the bond market. But in equities, we've just become profoundly cheaper. So, in March this year, at the kind of depth of the market, as COVID broke and lockdown was unveiled, then the South African market was as cheap as it had been in the GFC.
Yeah.
And relative to the S&P, the South African equities are currently pretty much as cheap as they've been in the last 100 years. So, in our view, it's a huge call to say, let's move into cash and let's wait and see. You're suggesting that you're going to know when the asset recovery is going to come. You're selling assets that are at some of the cheapest valuations we've seen in decades or even longer periods than that. Long-term bond yields, 15-year bonds are at yields of close to 12. If we look at the SARB's inflation target, let's take the midpoint of that, 4.5%. You're looking at the best part of a real yield of 7 or 8. That seems to be pricing in an enormous amount of risk. If you're rotating into cash and you're sitting in cash, you're probably going to be lucky to get a return of 4.5. Nominal. So 0 real, less probably if you're in a money market fund. I think that's going to be a very challenging outlook for those clients that in the last 3 years we know have kind of followed that trajectory.
Yeah.
So David, I just looked at the slide on some of those flows, and it is quite stark that effectively what the South African investors in totality are doing is taking their money out of the high returning assets and putting them in the lowest returning assets. So, your cash rate, as you've mentioned, has gone effectively 0 real. A couple of years ago, you were getting a real return on cash. You're now virtually getting naught real in SA cash. You're getting a phenomenally high real return in bonds. The industry as a whole is taking money out of risky assets, putting it in cash in some format. So they're basically putting in deposits at the banks, and the banks are actually buying the bonds with the cash that you're giving them. So they ride the yield curve. You're selling the South African government bonds, putting the money in cash, giving it to the banks, and the banks are buying the bonds. I mean, to me, it's very interesting that the South African investors in totality from the flows are choosing to sell the high returning asset and buy the 0 returning asset.
But I mean, there's something going on here that people are sort of trying to express. And to my mind, as you've sort of touched on, Marc, people are you only do that if you're scared, right? You only buy something that you know is never ever going to pay you anything in a real sense, because you don't think you're going to get your money back from all the other investments. So, to my mind, there's, people are struggling with this problem, and the flows reflect that. So, perhaps, you guys can give us some of your thoughts on, this question of default. I mean, we now know, what was 5 years ago a pretty, low, almost zero probability of default in SA. That's no longer the case. So, how do you, then build a portfolio to take that into account? It's a very hard problem.
Sure. Yeah, look, I mean, in 2008, South African debt to GDP was 25%. We'd run budget surpluses for a number of years. The South African growth had been kind of 4 to 5.5%. And, that had allowed us, that had driven the debt pay down. And so, the starting point of South Africa's indebtedness at the point of the GFC was pretty benign. We had the MTBPS update recently, and, peak debt now is expected at 95% of GDP, so pretty much a quadrupling in just over a decade. So you can certainly understand how investors are concerned. International investors have been selling the local bond market in an ongoing fashion, and they can easily kind of say, well, there are other investment opportunities that we can look for, and we don't need to be in South Africa, which is a relatively small global market. But having said that, obviously South African real yields, as we've touched on, at 8% are amongst the highest, if not the highest in the world for longer dated bonds. So, if we get even a modest improvement in the economic backdrop, then that could certainly, I think, reverse that global flow of funds issue. But I mean, circling back to the question as to how likely it is that we default, we're not a classic default case, because without doubt, the most common experience of emerging markets that default is that they have relatively large quantities of debt that's denominated in currencies other than their own. So typically in dollars and maybe some euros. And then when those markets have a crisis of confidence and refuse to roll over any of that debt, then obviously the default is precipitated. Much more difficult to get a country which where the primary indebtedness is in its own currency. So, I mean, those examples are not without parallel, but, some of those examples where, Egypt's an example of a country, obviously, that defaulted after the kind of Arab Spring there and went onto an IMF program. But, the Egyptian pound was on a fixed rate and it was very overvalued. So, when the default occurred, the Egyptian pound went from 8 to the dollar to 17 to the dollar overnight. And that was the catalyst to generate, inflation suddenly jumped, to 35%, and suddenly, you have a kind of crisis unfolding. The rands are freely floating exchange rate. We would argue it's slightly on the cheap side of fair, so it's not even that it's looking very expensive. And we've got a reserve bank which has got credibility, so much harder to kind of generate, I think, that kind of currency devaluation. So, the common kind of requisites or conditions that would normally exist to see a domestic default don't seem to be there now. Clearly, if we end up in 10 years' time at 150% debt to GDP, even if it's all in rand, there may come some point where things unravel. But I think that there are initiatives underway, and we have got time, and that's the key aspect. The market seems to be thinking we haven't got time. But one of the other interesting aspects that's worth just touching on briefly as well is investors who've moved to the short end of the yield curve or into cash because they think that's going to protect them against a default, and misunderstanding what's going to happen when that default happens.
Can you expand on that? Because I think that's
Sure. Well, Marc already raised one point, which is critical, which is to say, the cash that you've got is backed by the assets on a bank's balance sheet. And if those assets are substantially, or there's a significant portion of government bonds that are in those assets, then that bank is going to be impaired.
Yeah.
Undoubtedly, even without accumulating any further government bonds, the banks would almost certainly need some kind of recapitalisation if there was a significant write-down in South African government bonds in the event of a default.
So you're not protected.
So you're certainly not fully protected in your cash. And in your short-dated bonds, generally what happens in the case of a default is that all bonds, regardless of their maturity, receive a similar reduction in the capital value of that bond. Well, our short-dated bonds are trading kind of at par or above par. So whereas our long-dated bonds are already trading at, say, 70 cents in the rand. So they're already discounting a very negative scenario, and the short-dated bonds, not at all. So, actually, if the default would happen tomorrow, the big losers in the South African bond market would be the short end of the yield curve. So then you have to say, well, I'm holding these short-dated bonds and I think I'm going to be able to sell them to some other fool who's going to buy them from me before the default happens.
I think they call it the greater fool theory.
Yeah, I can tell you that door is very small, when everyone wants to get out. Most people who are owning those assets will get stuck with them. And I think that's a fundamental challenge.
So I just come in here quickly in terms of it. It's not even that the banking system necessarily owns sovereign bonds on its balance sheet, and you pick up a risk there. But banking systems and the sovereign are tied at the hip, in virtually by definition. And it doesn't matter even if the banks didn't have any government bonds at all. And if you look at their risk frameworks, they obviously will have government debt. But even if they didn't. A system where you have a central bank, a reserve bank with the banks, where its function is to backstop the banks, and the central bank is nothing other than an arm of the treasury. If you really think about the consolidated financials of a country, if your sovereign defaults, your financial system is toast. And so it's not that because the banks own the government bonds that the problem comes from. The problem comes from the systemic risk of that you are joined at the hip. And so there is nowhere to hide in a South African asset if the sovereign defaults. It's pretty chaotic, and you shouldn't want to get there. And it's very useful that the finance minister came out in his speech and basically said, I'm warning you that if you carry on and don't fix things like the government wage bill, that you are going to get behind. And they will fix the government wage bill at that point. They will fix it. We'll just get rid of everybody. They'll fix Eskom. They'll fix it. But it's a very, very painful way of doing it.
That's actually a very interesting problem that you're presenting, Marc, because obviously as a sort of long-term investor, one of the only free lunches we get is really diversification. So my next question is related to what you've just said. How much should an investor in SA who's saving for the long term actually have offshore? Is there a magic number at all? And secondly, related to that, what then would be the best diversifier? Because you've just told us we toast if everything goes pear-shaped with the sovereign. So you sort of can't just leave us like that. You have to give us some options.
Yeah. Look, I mean, Sandile, we've done quite a bit of modelling ourselves, looking at kind of optimal allocations to foreign assets for South African investors. We also recently, have been on the receiving end of a number of client queries that have been more or less in the vein of, shouldn't I sell all of my South African assets now because they've never been any good for me? And let me save what I can and get out into these juicy international assets that have produced these great returns. And the problem with that narrative is one, obviously, that historically it's factually massively incorrect. I mean, South African equities hugely outperformed the S&P between kind of 1994 and 2007, but in previous historic periods when you go back. So, you do get these long cycles of outperformance and underperformance. We've just had, a decade of underperformance. But I think some clients, they extrapolate that as if
Sure.
that's going to just be the situation forever and ever, without kind of recognizing what the relative valuations of the asset classes are. So, when South African equities are trading on a 1.4 price to book, and the S&P is trading on a 3.5 times price to book, that's telling you something about, the expectations that are embedded into the earnings delivery of those companies. And is the S&P really going to be able to grow earnings, at nearly 3 times the rate of South Africa into perpetuity? History suggests that actually that won't be able to happen. So, circling back to the question of optimal allocations to foreign, work that we'd done previously had suggested something like 25 to 30% was the right allocation for a kind of global balanced product.
But that's through...
That's through the cycle.
It's like a medium term.
That's right. That's through the cycle. When we rerun that analysis and took current market pricing, then that number actually drops. And you start to get numbers that are kind of closer to 20%, because obviously global assets are already priced expensive, as we've just touched on. They've kind of run hard. I mean, global bond yields, real yields are negative, and you've seen international equities, but most particularly the S&P, which bear in mind is half of the global equity market by market capitalization, now trading on close to a 25 PE. And that's an over a 3 times price to book. So there's a pretty elevated levels of valuation. To get allocations that are even like 50-50, you really have to kind of hit your expected returns on South African assets very hard indeed. You'd probably need South African equities to deliver in the next 10 years, maybe a 3% real return, half of what they've done, per annum over the last kind of 40 years. So it's a draconian view, and you've got nothing really to support, I think, that view.
And you've basically built a portfolio for one particular eventuality.
Sure. So I don't know if you have any thoughts, Marc, as well.
I mean, as sitting outside, what would you suggest?
So just starting on the sort of how much money offshore, given present pricing, so given simplistically, let's look at South African government bonds giving you a decent real return, and then you look at government bonds in Europe or in Japan or in the UK gilts, you're getting a negative return there. So if you're going to buy and hold those assets for the next 10 years, you're going to be pretty disappointed from your European bond exposure, because it's going to deliver you a negative number in real terms. And the best diversifying assets offshore for South Africans have always been the government bonds, US 30-year treasuries or Japanese bonds or European bonds have been a diversifying asset. The problem today is, and the US is slightly different, but the problem in the other big bond markets is that these are now negative numbers. They used to give you diversification and a positive carry and a decent return. Today, they will still give you diversification properties possibly, but the return prospects are constrained. So if you start rationally with pricing, with present pricing, if you've got 30% of your assets offshore in terms of your sort of pension fund portfolio, that's enough diversification. You don't really need to go starting to reach for 40-50% of your pension fund sitting overseas, because by definition, if you're just buying a global 60-40, you're buying a large portion of bonds that can't deliver you a decent return. In fact, on a buy and hold basis, they're going to deliver you a pretty bad return.
And I mean, I guess maybe you can. What are you buying offshore? Why are people buying negative yielding government bonds? Are people buying that stuff? What would you buy?
So lots of people have had this fantastic, if you've played the risk parity game or something, you've had this phenomenal joyride in sort of a global 60-40 portfolio, because the equities have done fine. They've actually delivered you a decent return. But bonds have delivered you much more than you ever could have believed possible. because the yield, you haven't just got the running yield. You've actually had price appreciation because the yield has squeezed. It's gone even lower and lower and lower, and now it's gone negative. And so you have borrowed from the future in global bond markets. So today, if you sit overseas, today you invest in equities, and you'll have to invest in the bond markets that aren't as challenged as the Japanese, the Europeans, and the UK gilt markets. So you'll have to buy hard currency emerging market bonds, soft currency emerging market bonds. You can buy the long end of the US yield curve, arguably still today, because on a relative basis, it still gives you a decent nominal yield. The real yield's negative, and it gives you good diversification properties. But on the bond side, you're going to have to take more risk, and you're going to have to be quite tactical about what you do. On the equity side, the big calls are: do you take money out of the S&P and put it into the rest of the world that's underperformed? And I would argue that valuations tell you that the odds of that now working over the next 10 years versus the last 10 years are on your side. So they're better than 50-50. So you should think about that. And you should think about, inside that, there are some phenomenally cheap assets in various markets around the world, emerging markets. Thailand is very cheap. Indonesia is very cheap. But actually at the stock level, there are some phenomenal cheap assets, just like South African domestic equities are a very cheap asset. You'll find the same thing in Thailand. You'll find the same thing in Indonesia. So if you get out of the big sort of global growth companies, there are a lot of decent returns to be had in equities, and I would suggest that's where one goes to look.
So effectively avoid negative yielding government bonds because you're guaranteed to lose money. You might not be able to sell them back to anyone at a reasonable yield, so you've basically locked in the negative real yields.
You're playing in parts of that. So you're playing the greater fool theory in places like Europe and in places like Japan. Those assets are priced to deliver you a negative return. They have a horrible skew distribution where if something happens, you can lose 30-40% of your capital. They might go even more negative. I mean, I never would have believed they could have gone this negative, but they might go even more negative, in which case you will make a capital gain. But the ability to drop the cash rate, the short end of the bond market so the policy rate, the ability to take policy rates lower is being constrained by some other effects that happen in the real world. And if you look at Japan and you look at Europe, they have reached the limit, it appears, of monetary policy. And so those bond markets are no longer able to rally because you're going to cut short rates. Now, of course, you can take your short rates more and more negative. It is possible. But there are some very big unintended consequences of that. And so it appears in places like Japan, which has been doing this since 1999, that you might have reached the limits of monetary policy. And therefore, the excess performance of those bonds is constrained. And if that's true, then the running yield is not a decent investment.
Yeah, and I guess then where do people go for alternative sources of yields? Are we supposed to be looking at hedge funds now? Are we supposed to be looking at private equity?
Sure.
So there's some good there's very good academic research on this, and you understand people want to go and reach for yield, and they want to find something else that can help them. When one of their base assets no longer supplies the long-term return you've been used to, but the academic research is damning, right? I mean, I point you to two papers. One is something called an inconvenient fact. It's a paper by an Oxford academic called Ludovic Philippi, and he talks about private equity returns and the billionaire factor, and he basically says private equity just makes the private equity sponsors wealthy, and you underperform listed equities in private equity after fees. And so, and also the diversification is actually, it's false. It's not true. The reason private equity looks like it diversifies you in an optimizer is because people don't market to market. So it's a bit like saying, well, my house will diversify me because I'm just not going to market to market. Well, try and sell your house in the middle of a market crash and have a look at what price you get. I mean, if you want to play that game, let's buy some red wine and put it in the portfolio and a couple of paintings, right? We'll choose what to market to. That's not useful. So that was the one paper. And the other very good paper is by Richard Ennis, and he was the editor of the Financial Analyst Journal for years, and he's done a lot of analysis of this as well. And his comment was, it costs you about somewhere between 1 and 1.7% annually is of the asset value is what it costs you to own these type of assets. And so he's talking generally there about alternative assets, and unfortunately they are no longer the diversifiers they were. So in the early 2000s, they were diversifiers. They did act differently when Yale went and invested in lots of these things. But the diversification has disappeared, and they are a significant drag on your performance if you actually look at your net return instead of just looking at the return of the fund before the fees. So I don't think that's useful. I think what you're going to have to do is you're going to have to be more tactical. You're going to have to be more dynamic, and you're going to have to move around between the assets that sell off because of behavioral events or because of risk premiums moving in the world, and use those opportunities to generate decent returns. So the big danger that you have offshore is if you're buying a 60-40 passive portfolio. So if you just go buy, say, the Vanguard 60-40 passive portfolio, 40% of that portfolio is not going to be able to help you on the return side. And passive investing today, you are making a very, very big active decision. You are choosing to invest in an expensive asset class for the rest of your pension time horizon, because the danger for me with passive is that people don't actually realize that they've now locked in that bond portion. And who's going to change your 60-40 to an 80-20 or to 70-30? Nobody. And so you by definition, by buying a passive portfolio structured like that, you are buying into the long run return. So you can't worry about the short-term return in terms of what you're doing today in cash, because you're challenged by your fear of the world. And then you go passive, and effectively you then buy the very long return. And we're not talking about medium-term returns. We're talking about the long run returns. And it's pretty guaranteed if you buy a Japanese bond today, you're going to get, if you hold it for the next 10 to 30 years, depending on which one you buy, you're going to get what it says on the tin, and that's a negative number. And so you're guaranteeing that by going passive. And I don't think people who do that realize what they've done.
So you don't have people like you and David to make your asset allocation for you if you're passive.
Look, I do think it's easier kind of in a way in South Africa, because we've already had a repricing of assets, so that there's a lot of risk premium, as Marc mentioned, for instance, in SA Inc. Those kind of domestic South African equities, the South African banks trading on close to 1 times price to book, as if they're never going to be able to grow their balance sheets again, and there's never going to be anybody that wants to take out loans. So, it obviously there could be circumstances in which, South Africa goes into another recession. We could have a global recession next year if we have another series of hard lockdowns. All sorts of unforeseen events can happen. But, history tells us that valuation does act as a significant buffer and protect you against that negative news. And you need to kind of understand, if you are that when you're taking an active position against those companies, that you are definitely leaning into a particular macroeconomic view that things will get worse. Those companies can perform extraordinarily well, by which we don't mean they're up 10% a year. We mean the share prices are going to double or triple or quadruple, with even a modest amount of positive news for South Africa. So, if we can see growth lifting into 2021 or 2022, to 2.5, then it's going to be an absolute game changer for some of those domestic South African equities, which they look like they're kind of on their back with their legs in the air, but it's a very dangerous thing to do, to kind of extrapolate that and then to base your long-term asset allocation on that, or to sit in cash and think that you're going to be able to hop out of cash into those assets, at just the right time.
So,
and then you look at South African bonds, which we've touched on a number of occasions through this conversation. The real yields are incredibly compelling. So you've got to ask yourself, when you look at that gap between 10-year South African bonds, and South African cash, how much do you need in terms of that gap to compensate you for the risk? You're getting, depending on the maturity, 5, 6, 7, 8%.
Real.
Yeah, real.
So this is after you've taken inflation
after you've taken inflation out. So no, that's you haven't seen risk premium like that in South Africa since around 2000, 2001, when we were coming out of the emerging market crisis, and inflation, you hadn't had 2 decades of inflation targeting. So
what's the catalyst that gets people back into the market?
Yeah.
I know you hate this kind of question.
No, I mean, people ask all the time. People say things like, I know you don't forecast, but can you just tell me what's coming to the rand in the next 3 months? So, I mean, funnily enough...
You don't know?
So funnily enough, I didn't see COVID coming. We didn't see that,
Sure.
We didn't see Nenegate coming. We didn't see the Euro crisis, and then we didn't foresee Mario Draghi coming out and saying, I'll do what it takes. So history's kind of littered with examples of events that, I mean, not just Prudential didn't see. The market had no idea that was going to happen. And that's why, if you look at, for instance, valuations, particularly in equities, you look at the prevailing valuation now, it tells you nothing about the return over the next 12 months. We've done lots of work, and it's available in academic space too. You can tell nothing about the subsequent 12-month returns, but you can tell a lot about the next 3 to 5 years from the starting valuation point. So, seeking catalysts, I can come up with, a dozen different plausible scenarios as to what would kind of drive things. If we got a public sector wage agreement in South Africa where we had a 3-year wage freeze along with a renegotiation of the final year of the 2018 deal, so obviously that's going to the Labour Court in December of this year, then I think that could be one thing that obviously would be a great positive sign. We could see the US coming out with another big fiscal stimulus after the election, and that could again prove that the government authorities are kind of absolutely determined not to let the US and the So those are just a couple. I'm sure Marc could also come up with endless scenarios, but it's a very dangerous thing to do to think that you can do that, and even worse is probably to come up with 6 scenarios that you kind of think are the core scenarios, all of which will be wrong, and then assign probabilities to them. So, but Marc, some thoughts from your side?
Catalysts are, it's nice if you can identify a catalyst. It's very dangerous to invest on the basis of a catalyst. What's going to change this, and I'm going to see it, and then I'm going to invest. My sense is that lots of people who talk about catalysts, and effectively they don't want to do the very, very hard thing, which is to step into the risky assets after they've done badly and after you've had a bad experience. So you sit in cash, and then you use the catalysts as an excuse to not buy anything, because you actually don't want to buy anything. It's not really about, I'm going to sit in cash until I see a catalyst and then I'm going to put it to work. It's worse than that. It's just a behavioral trait that you actually don't want to have to live with the volatility that comes from doing the exceptionally hard things like buying SA government bonds today. And so you make up the catalysts. You make up the catalyst game. It's fraught with problems. You can dream up plenty of them. Will any of them work? And And you're probably identifying your catalysts. You're probably identifying your catalysts after the fact, because sometimes things just start going up because they're cheap. We never identified that when we had 6% real on the inflation, when the inflation-linked bonds were 6% in 2000, I think about 1 somewhere around there, we never identified that they were going to go all the way to 1.7. And what drove that? We had no idea. So it's a mug's game. It's better to look at the valuations and say, well, good things happen to assets that are priced for big returns.
And I'm going to throw one last thing at you, Marc, that's hopefully less confounding than forecasting. And it has to do with valuation, so don't get cross with me. The gap between value and growth, I mean, that's pretty much part of the theme of why, some of the risky assets have underperformed. I mean, your sort of quick thoughts on that?
So career-defining call. It's about as wide as it's ever been. If you measure correctly, so you don't just use MSCI value and MSCI growth and then do price to books or PEs or something. If you actually sector country neutralize those indices, so you create a value index that is country neutral and sector neutral, and you create a growth index that's country neutral and sector neutral. Up until 2018, there actually wasn't this massive underperformance of value. Most of what people were observing in value underperformance was a sector problem. You've been buying oil stocks and they're going down, you've been buying mining stocks, or you've been buying banks, which is the big one. So the value indices were full of banks because banks were just getting cheaper and cheaper and cheaper. And they were fundamentally economically challenged as well in places like Europe, where your margins were, your NIM margins were narrowing because of monetary policy. So up until that point, the value growth underperformance wasn't as big as you thought, but subsequent to 2018 and 2019 and now 2020, effectively value is derated. It's interesting, the earnings numbers haven't underperformed by more than one would normally expect value to underperform by in terms of earnings, but the PE has just fallen. So they've just derated value. You've now got this very, very wide gap, as wide as it's probably ever been. Which says that you should possibly be leaning into this to a certain extent. And as I said right at the beginning of the comment, it's a career-defining call. Yeah. Because if you do this too early, there's very big career risks for professional asset managers, which, lots of people have tried this before, and you eventually get fired because if you do it 5 years too early, even if you've got a good track record after 5 years, either the management fires you or the client fires you. So it is a career-defining call. It is very, very wide. I would suggest that you should be leaning into it. The biggest academic sort of issue, the biggest intellectual issue is not exactly sure about why it's derated. So, it's quite useful if you're going to get seriously involved in an asset to at least understand what got it to where it is. You might not know where it's going to go, but you would like to know how it got here. And it's still very unclear. There's a lot of narrative stories. There's lots of stories about its duration or, and it's not if you actually look at the data. Empirical evidence to back it up. So you have this astounding derating in value with no real apparent reason. And that makes it a very challenging call. If you're a hardcore value investor, you just buy it because the long run returns look decent. If you just simplistically look at the odds have improved a lot in the last 2 or 3 years. That a value trade that you take today is a better bet than it was 3 years ago. But that is stating the blindingly obvious, right?
Which is, it's always obvious, but it's the hardest thing to do, isn't it?
Sure.
Well, I think, we could probably get carried away and go off on this for some time to come. But I think I will put a pin in it there, and we can open it up to some Q&A. Once again, a reminder, please do continue interacting with us still via the live Q&A chat. We've got moderators. We're able to see the questions, and we'll try to get through as many of them as we can. So thanks once again, and I look forward to answering some of your questions. Yeah, I think you can put it on now. Yeah, welcome back. And I see you've got a number of questions to get through. So yeah, let's crack on. This one's for you, Marc. What is your view on changing asset allocation during volatile times, and how does this impact the Global Balanced Fund?
So I think you should hope that your manager so let's define sort of volatile times. If by volatility we mean what we had in March, where asset prices move significantly away from any sort of so they become either very, very expensive or very, very cheap, one should hope your asset manager is going to move his asset allocation significantly, because in significant opportunities, when the earnings yield gets very high, so the PE gets very low, equities get cheap, bonds get expensive, one should move. Those opportunities, they happen more often than one thinks, but they're very lucrative. The interesting thing is two parts to that. One is most people don't do it, and I suggested that's a behavioral problem, that it is so frightening at the points where you have really good opportunities to move your asset allocation a long way. Most people are too frightened to do it, because the assets don't just fall out of bed for no reason. They observe COVID. They don't understand what it means. They think it can have phenomenally big economic effects. And so the assets move significantly, and everybody's sitting there scratching their heads, versus just observing the valuations have moved a long way would tell you to, get involved in the cheap assets, sell the expensive assets, and stop betting against the human race. So that would be my take. It's very hard to do in live in the real world. It's very easy to talk about it as an academic. And the second part of the question is, the other part that does get difficult in some of these, it wasn't always true, but in some of these events, that you have liquidity issues. So the assets that you want to sell become illiquid and much more difficult to move. So sometimes, unfortunately, people are constrained by their own ability to move the assets that they want to sell into, to buy cheap equities. You've got to sell cheap investment grade bonds, and that gets much more difficult. That's a bit of a story of the COVID. I mean, during the COVID event in March, the investment grade bonds, even the most safe of investment grade bonds, were trading 10% away from the sort of indices. So the ETFs moved 10% away from the indices. Told you how much liquidity problems there were. So it was difficult to do, but if one can do it, or one happens to be sitting in treasuries or sitting in US 30-year bonds and can move those, you should do it.
Yeah. Okay. Sounds good. Anything to add, David?
Look, I think Marc has kind of covered it. Clearly, we have had, certainly, if I think about the questions that have come at us from clients during the COVID period, people from a South African perspective have asked, shouldn't I take all my assets into offshore? We have talked, quite a lot about that. They've asked about gold, an asset class that's pretty much impossible to value. Everyone wants to avoid the pain of the negative returns, and our experience is, there's generally no silver bullet to that. There's no asset class that you can definitively say that's going to protect you in these kind of environments. And our experience is, that the best way to deliver superior returns over the longer term is to buy cheap assets when the market prices them like that.
And ride out the pain.
Yeah, look, I mean, diversification obviously is really, really important. A global balanced product is going to have, some natural exposure to diversifying assets, but then, in a risk event, that diversification also becomes less kind of potent than you would hope. And I guess, we've been saying, to clients for some time, moving your assets now into cash. I mean, not just globally, which has been an issue for a while with global cash rates kind of zero or negative, but now also locally, where you struggling to find cash returns much above 4%. That's going to be a serious long-term challenge.
Well, I've got a few other questions. One of them says, would an early find for the virus vaccine affect the market quickly? What's your take?
Yeah, I guess one would think so. To the extent that there's, investors have worried a lot about, as Marc was just intimating, about the macroeconomic impacts of COVID. We're seeing Europe kind of locking down again in a kind of semi-hard fashion, but certainly there are going to be adverse growth impacts from that. So it's natural, I think, that the growth-orientated assets are going to worry about ongoing waves through into 2021. And if you had a vaccine and you can deploy frankly, billions of doses of that vaccine around the world in a speedy fashion, then that's going to decrease kind of risk premium. But as ever, these things do depend on what are prevailing valuations before the event happens. Maybe the market's going to anticipate all of that before vaccines are ever delivered. And so those kind of strategy that says let's wait until everyone's been vaccinated. You may find, as people did in 2009, while they sat there and waited to see how the aftermath of the global financial crisis was going to pan out. In March, the S&Ps hit sort of beginning of April 666. By the end of the year, the index had doubled, and you're still sitting there kind of wondering, what's going on in the global economy. So, we kind of circle back to this issue of kind of saying cheap assets are one of the mechanisms by which history suggests you can protect yourself, admittedly with volatility along the way. I don't know what Marc. I mean,
Marc, your thoughts?
Yeah, I think some very positive news on vaccines could move risk premia, can move people's perception of assets. I don't think any of it does anything to the long run dividend discount model on the S&P 500, for example, because I don't understand why next year's earnings really matter. They don't. What matters is the 20-year dividend discounts, the 20-year dividend stream. So don't think there's anything really going on in the fundamentals, but obviously there's a big sentiment piece. If the world's got, I think the numbers are, there's a manufacturing capability to get 100 million vaccines out by December, and we'll have over 1 billion in 2021, right? That's been set up. So if you get a vaccine that has some sort of efficacy and works, I think you might get quite a big sentiment shift, because if you say I can vaccinate the vulnerable, and remember, we've locked down most of the population of the world, and they're not vulnerable. It doesn't matter. For them, it's like the flu. So then you can stop locking them down, and you say, well, okay, the vulnerable people we've got a solution to. We don't want to kill lots of old people by running around, and young people running around and having parties, but we vaccinated the old. So, it allows you to make better policy decisions, I think. If you as a politician had this and said, look, I vaccinated all the people in the care homes, so I don't have quite the same problem that I had before, and then the pressure on lockdown would be much lower from a political point of view, and that's useful.
Which is what people have actually been struggling with, especially in the this sort of recent second wave. Okay, well, there's another one for you, gents. What's your view on default risk in global credit? Interesting question. Do you foresee COVID causing a wave of defaults? How do you think about it, and any strains on the financial system? I mean, we've sort of had the first flavor of that in March and April, and I think the Fed dealt with that quite well. I mean, thoughts for if we have another resumption of a fear of defaults?
Look, it's hard not to think that the most significant global recession since the early 1940s is not going to produce at some point some casualties in the corporate world. There are companies that went in kind of over levered for this economic outcome, and currently they're being kept afloat by the various monetary measures that have been deployed by central banks and by the fiscal assistance from national treasuries around the world, that have kind of kept consumer demand going. I mean, in some cases, you know, in the US, household income actually rose as a result of the payments that were made in lieu of work for people who had been furloughed. So, I mean, it's extraordinary. I mean, unprecedented, in fact, for that to happen in a recession. But you know, there are plenty of companies. You know, we could look at hospitality, we can look at airlines. You know, you could look at cruise ships. You know, they've property. We don't know where that's going to fall out. I mean, in the global financial crisis, about 10% of US high yield defaulted. You know, obviously interest rates are much lower, so you know that definitely helps.
I suppose that helps on the margin.
But I think it's reasonable to think that at some point, when as the stimulus kind of starts to wane, that we will see some of the more vulnerable companies either being taken over or defaulting.
I mean, Marc, what are you doing in the global portfolios to think about this?
I mean, we own things like fallen angels. We own some high yield, you know, global and US high yield. You know, we also own the fallen angels, which is an interesting place to go, and because the recovery rates are better there, and they can also get back to investment grade. But this is beautiful forecasting question, isn't it? The market knows this is a very tough economic environment. The market knows there are defaults coming. The market expects those defaults to be pretty high. The market also knows the Fed's got involved to a certain extent, and the markets have been open to allow people to extend the ladder and so buy themselves some time so they can roll over their debt. And you know, all of these things are known by the market. And there's there are thousands of credit analysts around the world. So these are all known facts. So what, do you think you have some superior insight into what global defaults are going to do, and you're going to make a call on US high yield or investment grade on the basis of a default forecast that you're going to make? I'd suggest that that's an undoable thing. The market knows there's defaults, it knows it's a tough economic environment, and it's offering you still a pretty decent spread to get involved in these assets. And it's also differentiated inside those assets if you go and look at the, you know, if you break it up and look at sectors, etc. So the question is there excess risk premium in those assets, given the terrible outlook and the defaults that people know about and the defaults that are going to come? And do you expect the market is being too optimistic? And I would say, given the nature of the world and what we're facing, I'd say there's probably excess risk premium in there. And so I wouldn't take on the, you know, the spread on US high yield on the basis of my personal forecast of defaults. I think you'll get paid to own them, and I think there's excess risk premium in there because there should be.
And that's what you get paid for. Yep, makes sense. I think we've got about 5 minutes to go, so I'm going to hit you with two punchy questions. What is the asset allocation one should have at the moment in SA? David, do you want to kick off?
Look, I mean, I guess if we took a kind of global balanced product, then if you look at our portfolios, then we're overweight assets that we think are cheap. We're overweight South African equities, valuations, not far off as cheap as they got in the global financial crisis. And we were currently South African markets trading on half the price to book of kind of corresponding developed market equities, which is pretty extreme. So not quite as extreme as we were kind of in 1998, but after that, this is one of the most kind of relatively cheap kind of valuations for SA equities. South African bonds, again, real yields at a 20-year high. Clearly, it circles around to Marc's comments about kind of credit risk and, what you can know relative to the market. I mean, we all know about South Africa's fiscal situation. The question is, does an 8% real yield compensate you for the possibility that there could be some requirement to have some kind of haircut on those bonds? I think we would suggest that it does. Certainly not, in our view, a foregone conclusion that South African government's going to have to default. I think we're a long way from that. And the World Bank, I mean, that's not just our view. I mean, the World Bank and the IMF have made very similar comments as well about South Africa.
I don't think they'll give them any money.
So, yeah.
Default.
No, exactly. We're also long South African bonds. What's the asset we don't like? We don't like South African cash. I mean, you're getting currently a barely positive real yield on your call money. Inflation's likely to start ticking up into 2021. That's the consensus forecast. You're then going to be getting negative real yields on cash. So that's pretty unappealing. I think, obviously Marc can.
Marc, what would you buy?
So you've got to be out of global cash. You need to own global equities. You need to then look at your bond portfolio. And you need to own hard currency emerging market bonds, soft currency emerging market bonds, and parts of the credit market around the world. Avoid Japanese 30-year bonds, European bonds, sovereign bonds, and UK gilts. Diversify US 30 years. That's the portfolio. That's what Valuations is telling you to do, as well as you're building some diversification into that.
Yeah.
And I mean, perhaps one thing to add quickly there. I appreciate we're running out of time, but it's just in terms of the SA versus offshore split.
Yeah.
Because as I intimated, I think we have had a number of kind of clients suggest to us that South African that they should just sell all of their South African assets and buy offshore. I think that would be a massive kind of mistake at this point, given the relative valuations that we've talked about at some length. And it's certainly not true that historically South African assets haven't outperformed their global peers. They've had long periods of outperformance through history. A very substantial outperformance. So I think it's really the last decade that has been kind of poor for not just for South Africa but emerging market equities in general, relative to, in particular, the S&P. So people remember that because it's in their most recent memory. But they've kind of forgotten that the previous 10 years to that, the S&P gave you nothing, and South African equities are giving you 15% per year, kind of compound in rand. So,
And I guess last question: what do you do if we're wrong? I mean, how do you mitigate for risk in the portfolios? Final one. 2 sentences.
There isn't a silver bullet here, but buying cheap assets in the long term is the best way to try and ensure the highest probability of a superior outcome. To think that we certainly don't think that we can zig and zag in and out of kind of cash.
We've done research. You're going to get a high.
It's really look. I mean, Marc does highlight a really important point, which is you do need to kind of be prepared to tactically allocate into assets as the market provides you with opportunities. So it's not that you have a kind of static asset allocation at all, but the notion that you could have the lion's share of your assets sitting in a product that's pretty much guaranteed to deliver you a kind of 0 to negative real return. And you're going to be able to know when the right time is to hop into risk assets in a major way. That's
we can't do that.
I think that's very, there will be some people who do that, who make, a career out of that one call. Was that skill or luck? We would say that's almost certainly luck. That's I think that's where we are. Are there scenarios right now that could obviously derail or delay the recovery in asset markets? Of course there are. If we have a global recession again in 2021, that will cause risk premium to remain elevated. yeah, again, I think, in terms of buying a perpetual asset like equities, the long-term effect on those cash flows is actually quite small.
Yeah. Marc,
So
2 sentences.
I'm going to say more than 2. Just US 30 years are the defensive asset. They might stop being the defensive asset. Unfortunately, lots of defensive assets from the past are no longer defensive. So it's a very, very tough game. But you should ask a harder question. The industry is chaotic. The industry has got risk analysis after risk analysis after risk analysis, and everybody's worrying about what happens tomorrow or the next day or the next week. I mean, just look at COVID. The S&P is basically back at its highs. Where's this COVID problem? It's disappeared. If you went on holiday in January and you came back now, you'd say, what was the problem in terms of asset problems? And so the industry itself is running around trying to mitigate tomorrow's fall in asset prices. But we're talking about pension funds and savings on 20-year time horizons. So the best advantage and my best advice to people who are not being forced to play this game with 3 levels of risk analysis and management coming and telling you what to do, etc. You don't have to play this game. Just buy the decent assets with the long run returns, and you don't have to sell your pension fund tomorrow. And who cares about the mark to market? Start focusing on the fundamentals, and you'll come out ahead, and you'll win, and you'll feel less stressed about life.
That's brilliant. Look, I would have allowed those extra sentences. I mean, that was a great way to end off. Thanks again, Marc, for joining us. Thanks, David, for joining us, and once again, thank you to our clients and all the people who've dialed in. We do appreciate your time. I am very well aware we got many more questions we couldn't get to, so we will make an effort to respond to each one of those questions, either from ourselves or from our sales and business development teams and distribution teams. So thanks again, and good luck, and keep safe.
Yeah, and the video is going to be available.
That's right. The video will be available on our website, or we'll send you a link via the invitation email.